So is timing the market a myth or is it a strategy? Isn't that the question everybody wants to know? Because doesn't it make sense to sell when the market's high and buy when the market's low? Obviously it does. But that is quite difficult, especially with the news that comes out on a daily basis. And we have information to show you that no matter what happens in the market, markets are resilient and they always go up over time. Why? Because we're always going to continue to eat food and use the internet and use electricity. And as long as we consistently have the belief that we're going to always work for money, that's why we believe in capitalist markets, and markets are resilient to that. But people are emotional, they freak out. But your investment should be long term. And because we know that these companies are designed to make money, we always recover. So I do want to go over some examples of how the markets have been volatile. When you take a look at the Great Depression, some of the massive market drops that we've ever seen in history, well, a lot of it happened because there was no regulation. We could have just said we had a company that was making hundreds of millions of dollars and the market would just go up because investors had no clue. Well, there's regulation now since 1933 and 1934 that does not allow that. So realistically, after that is when we should look at market drops, because I personally don't believe there will ever be a market drop of that magnitude. So when you look at World War II during the 40s, you can see the volatility in the markets. In the late 40s, we had inflation to almost 20%. Yet again, you can see the market drops. Korean War in 1950s, Vietnam in the 60s. You had the oil crisis of the 70s. Heck, the market was down 43% during that time. A balanced portfolio was only down 23%. Then you had the 80s with Jimmy Carter. You remember inflation at 20%? And then you had Business Week saying the death of equities. Well, you could see shortly after that what happened. Then you have Black Monday, 1987. The market dropped 23% in one day, which, oh, by the way, the stock market ended positive that year. Then you had the Gulf War in the 90s. Cold War ended shortly after. Then you had in the 90s, Irrational Exuberance by Alan Greenspan, one of the smartest economists at that time. And what happened after that? The market boomed. Then you go through the tech wreck in the early 2000s, the 2008 financial crisis, and then ending with COVID. In all of those scenarios, markets increased. Why? Because that's how it's designed. Think about it. The stock market has risk and reward features. You've taken the risk. You lost the money. Stick around for the reward. In my opinion, timing the market is an absolute myth. There's been nobody ever in the history of investing that's been able to do two things: choose individual stock on a consistent basis where they're always winners, or time markets. Stay disciplined, focus long term, and avoid all the noise that's out there.